You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tosaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, that rocking tune means it is time once again for the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we around here like to refer to as the Options Insider Radio Network. And if you haven't done so, I know a lot of you have, but a handful of you may have missed it. So run, don't walk to your app store and check out the brand spanking new Options Insider Radio Network mobile app, available, of course, in the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store for all you Amazon junkies out there who love your Kindle Fire devices. You can, of course, stream all 300 plus now episodes of the Option Block instantly from wherever you might be. You can also download them. I know a lot of you guys like to store them for offline listening in your commute or on the plane or traveling or wherever you like to listen to this fine program. And of course, you can take advantage of that contact suite to reach out to the hosts here on the show and ask all your questions and comments and all that great stuff. Check it out, the Options Insider Radio Network mobile app. I think you're going to like it. And joining me on the show today, we have the usual cast of colorful characters, starting off with the man who owns many, many fancy hats. He is known far and wide as the Viceroy, none other than Mr. Alex Jacobson from Options Express by Charles Schwab. Alex, welcome back to the program, sir.
Yes, Mark, I'm here, and I have less voice than Andrew, believe it or not. But as Andrew said, kind of a very quiet day today, but it's good to be here.
All right, and we shall turn to the man holding down the RCM satellite office out there in the hinterlands known as St. Charles, Illinois. You know him, you love him, as Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome back to the program, sir.
Always exciting to be here on a Monday.
All right, and also joining us from the great state of Maine, you know him, you love him, as the Rock Lobster, none other than Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the program, sir.
I was just panicked I didn't have my mute button on. Everybody had such a hard time. I am doing well. I have no voice, unfortunately, because the last hockey game of the season was Sunday, and 5 games in one weekend is far too much for a parent to endure. I'm just letting you know.
Yes, I find a lack of a voice is very conducive to good radio.
So I'm trying to be what's left of my voice being plenty loud and emoting as I go through actually what was quite interesting activity today, I must say, on a kind of meh day, as you would say.
Well, with the gang all assembled, we're going to dissect that quiet day because it is time once again for the trading block.
The trading block.
All right, and welcome to the trading block. You guys know the drill by now. This is, of course, the portion of the program where we break down what was moving in the old markets today. And as everyone alluded to, a bit of a quiet one on the street, but not as quiet as it may have been in some other recent sessions. Certainly wasn't an unch today. S&P closing down about half a percentage point to 1857. The Dow, a bit of a laggard, only down about a quarter of a percentage point, about 26 handles on the day. 16,276 is where that closed, and the Q's off fractionally as well. Fixed cash taking a little bit of the weekend back, but there were, as Andrew alluded to, some interesting nuggets throughout that otherwise relatively blasé day on the old street. So, Mr. Giovinazzi, since you alluded to them earlier, we shall give you pride of place. What were some of those nuggets that caught your eye in today's activity?
Wow, I get to go first. I just fell over. I had to get back up to the mic. What the biggest thing was actually for a down day for the index, we actually finally had a drop in the curve, in the skew curve, drop in volatility just a little bit. Even though the VIX is staying up 12 cents, with the market down about 0.5%, that's net like a negative. So for whatever reason, the bid and the volatility came off, and what I find, and that's the question is why. The only other thing I can see, since I think every momentum stock was down about 4 or 5% today, somebody blew the all clear signal, not quite sure, but very curious on that. So, with the treasuries continuing to rally, I'm starting to believe now it's a bit of a short squeeze there. Everybody was sort of piling on the Yellen news when she became hawkish, and I think I'm feeling like there's some kind of short treasury covering that's sort of dislocating the market in a very large way. But that's just a closet opinion. I don't have any hard facts for that yet.
And Uncle Mike, since our fellow co-hosts are a little bit under the weather vocally wise, I shall turn to you next to give them a chance to recover. What was the BBI like today? What caught your eye in the morass that was today's activity?
Well, it was pretty exciting early in the day. Rolled down a few put spreads. So talked about this on the show before, in that when you have a short put as part of a greater strategy, so to speak, if you roll it down and out to another month, if you can get a pop in volatility, doesn't really hurt so bad. Yeah, it's obviously a losing trade at the time, but that's one adjustment that I really don't mind making, so long as it's part of a bigger structure, which in the cases of what we're doing today, it is. Rolled down a long put in GLD today, our September protective put, and just rolled down a few puts and took some profits on some short puts in Apple. So pretty much the moral to the story, just buy Apple, everybody. It's that easy.
It is just that easy to be a wealth advisor today. Just put some Apple on, write some puts, and you're a happy fellow. And then go home and go on vacation like Andrew, and you're good to go for a while.
And then just sweat it out for an extra week, and then you're all set.
Yeah, just that easy. I love it. Just stock up on some antacids. I find Tums to be very effective. And then you roll the dice and you're good.
Yeah.
Mr. Jacobson, I know you have less voice than Andrew, but what caught your eye in today's activity, sir?
The social networking stocks were part of the carnage today, and that's become a very active category here at OX. When I spoke to the desk today, they actually spent a lot of the day managing customers because of the unusual SPX settlement on Friday. I'll talk a little bit of the Xpress Block, but the desk didn't have any real standout names today. And as I said, they were kind of managing a group of unhappy customers because of Friday's events.
Some other stuff lighting up the old options tape. As I've said on some recent shows, I was touring the globe, or at least Florida, recently, hitting all those derivatives conferences, and a lot of interesting data coming out of those events. and we talked about a lot of them on various shows on the network. One of them I want to get your guys' takes on as well here on the show, as well as put it out here to the high-end retail audience of an OX Schwab, is some of the use cases we're seeing for options amongst some of the big institutional players, in particular the mutual funds out there. People are always writing to us asking, hey, what are the big funds? Do they use options? If they do use options, what are they using them for? And we've always given our ideas, but there's been very little actual hard data on that until now. Our buddies over there at Goldman putting out a study on the mutual fund use of options. Some interesting nuggets coming out of that. First off, of the big fund families, 5 of the top 15 fund families, so a third, now have funds that utilize options in some way, shape, or form. Overall, at least 196 funds now use options. Of these 196 funds, they have a collective nearly $500 billion in assets, $480 billion in AUM at the end of 2013. The strategies they utilize in these funds, it kind of breaks down in some of the ways you might expect, with a couple little surprises. 64% of these funds utilize short calls, so that's your pretty much basic covered call use case that most long equity funds are employing. 22% actually in short puts. That kind of surprised me a little bit. Again, that goes back to the income generating use that a lot of long equity funds like to use for options, and that actually shows that they have some sophistication in terms of using a short put as a way to circumvent working a long limit equity buy order in a stock. Only 8% actually in long puts. That one kind of stuck out at me a little bit because the primary use case for options since the very early days of the business was as a hedging instrument. You would hope that given the top-heavy nature of the marketplace right now, that a lot of these funds would be flocking to protective use cases for options like long puts, and yet that isn't really the case. Only 8% utilizing that strategy, and then even fewer, 6% in long call, so even fewer utilizing options as some sort of delta surrogate or directional surrogate for the underlying itself. So a lot of interesting metrics coming out of that. Oh, and one more thing, they also broke down some of the performance of these funds. Over the 5 years that they evaluated that ended in March of this year, they found that funds that use options overall had higher returns, lower volatility, and higher risk-adjusted returns than their peer funds that did not use options. So across the board, they win. Total return, risk-adjusted return, and in overall volatility, these funds win, which is interesting given the fact that so many of them focus their liquidity on riding the out-of-the-money call side of the curve. You'd think that sort of strategy would underperform net over the past 5 years when we've had a predominantly bull market, yet even in that scenario, these funds have performed well and outperformed their peers who don't use options. So Uncle Mike, since you are the one with the strongest voice amongst our co-hosts here today, and also active in the wealth advisor arena, any of these metrics really leap out at you as surprising or perhaps par for the course? What's your take on the results of this study here?
Well, I like options, and
you don't say.
I think it's about time in that you have ways with which you can collect income. And I think number one, it shows the fact that they're writing premium. It's just the desperation for income these days. And in my opinion, income is just the buzzword in the investment world, or it feels like that. And what I think a lot of the funds may be doing is using the covered call and short put strategies as a way of you getting income. Now, whether that's right or wrong, that remains to be seen in the coming days, months, and years in the marketplace. So I think that's kind of the direction where a lot of them are going. In terms of using the options for protection, a lot of that is out there right now in the annuity world. Whether it's good or it's bad, I've been on several soapboxes on that. I'm not going to get into that right now, but my theory is that if you were to do that same statistic, you'd see a lot more long option buying in one way, shape, or form in the variable or indexed annuity world in one way, shape, or form. So I think it's good that we are starting to use options in one way in the mutual fund world. Are they where they need to be? In my opinion, no, they have a ways to go. And in fairness to them, there's rules that mutual funds have to follow in terms of being totally diversified. And if let's say that you're in 200 stocks within your fund, and 50 of them are really good stocks that you really like, but the options aren't very liquid on it, your hands are going to be kind of tied. So it's a step in the right direction, but I still think we have a long way to go in the mutual fund world.
Mr. Andrew, what's your take here on these results from our friends over at Goldman?
No surprise. I mean, you got to be realistic. I mean, if you can sell puts and they're 10% below the market, you have a good shot to outperform. You could sell calls above the market. I mean, I think the thing that most people don't understand that are so hung up about trying to outperform the S&P 500, so many funds, but if you're the average public, you just buy the SPY, and every once in a while you sell an out of the money call in the SPY and you will outperform. There you go. You've already outperformed 80% of the mutual fund industry just by using an ETF and writing a couple of calls every year. So I think that the biggest problem with options, which partly this show helps address, is I still say that the public is probably, unfortunately uneducated in how they work. They get awful press from, the financial crisis and stuff. When actually the OCC was one of the few institutions that did not have a problem, and they clear option contracts because they actually know how to margin them properly, as opposed to all the banks that have all that OTC stuff that is totally unmarred, that is not margined properly and not transparent. So understanding how options work go a long way to helping you make just a little bit more money than the market indexes. And when you understand about using options in that way, where you're not trying to swing for the fences every time and you just want to make your little pile of money bigger from this year to the next year, then that's when you start looking at options in a serious way, and you're ready to make some money using them. So does this surprise me? No, because I made most of the money in my life trading options. So it does not surprise me that this is possible.
No, not that it's possible, that just that the funds are utilizing them, A, at all, and B, in these types of percentages. It certainly seems that they have gravitated towards the income side of the fence. They understand that portion of the equation now. Now we just need to get them on board with some of the more, let's say, defensive-minded strategies out there. Mr. Alex, I know you spent the better part of your adult life in the options education business. What's your take here on these funds? Really loving the income side, not so keen on the protection side.
I think this is a testament to what the SIBO did to create tradable benchmarks. When you're a fund manager, you get measured by some performance standard. And in the mutual fund industry, you live or die off that performance standard. And I think when the SIBO created the buy right index and the put sale index, not only did it bring billions into those specific strategies, but it created the benchmark. And in fact, in retail, those of us who deal with the individual investors, that's the one thing that we've never had, because individual investors will ask that question all the time. What should I earn? What are my risks? And the great thing about the institutional business, and this is true of hedge funds as well, because there are benchmarks for hedge fund strategies, is they can see a relative benchmark. And, when you say the two most popular were the covered right / overwrite and the put sale, those are the two SIBO benchmarks, and people can see themselves there. Does it continue to be a tough sale to funds to embrace options? Yeah, it's still tough. And last year when the market was up big, believe it or not, in many ways that hurts, because some of those income-oriented strategies underperformed, and you get a lot of "I told you so"s from the community that doesn't want to embrace them. But I think one fiction is institutions have looked at this, and many of them that don't do it because they choose not to, not because they don't understand. But the funds that do embrace it big time. And there are fund families that will have a derivatives desk, and that derivatives desk will provide solutions. And you will find that those funds do it a disproportionate amount. Any Goldman study, the devil's in the details. Some of the biggest users of options have always been the sovereign funds, and I assume they're not in that study because It sounds like that study covers mutual funds, and I assume domestic mutual funds. And it's always interesting to see how options are embraced outside of the United States. And generally, there is surprisingly much broader acceptance outside of the United States than there is in the United States in the money management community.
And if you want to check that study out for yourselves, listeners, you can check it out over there at the CBOE Options Hub. That's where they have all the presentations from the RMC conference. You can read it over at your leisure and make your own conclusions while we keep on rolling with the show right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, you know what that funky tune means by now. It means it's time once again for the Odd Block, the portion of the show where we break down the weird, the interesting, the downright unusual activity that's lighting up the old options tape today. And we're going to kick things off with Quest Diagnostics Inc., ticker symbol DGX. Closing today, $55.52, down about a quarter or about 0.5% on the day. This is the name that does, about 2,000 contracts a day, doing about 15,000 contracts today. And a good chunk of that coming in one size upside buy, financed by some out-of-the-money put sales. We saw a lot of liquidity flocking into the April 60 calls. We profiled actually this morning on the site about 1,924 going up in one big block, but a lot went up on the day after that, a total of 9,359 calls being purchased for prices around 20 cents. Seemed like the bulk of them went up for that price. Open interest is nominal, 15 contracts. This is all open in paper. If you get them for around 20 cents, you turn around on the flip side and they blast out about 3,000 of the May 50 puts for prices around 60 cents. So you get that roughly 3-to-1 ratio. That should cover the bulk of your expenses. And you've got your time risk reversal here in Quest Diagnostics. Senior G, what is your take here on this upside call by financed by some downside puts?
The only thing I could say is Daddy wants the stock to go way, way up. I don't think Tosaw could create something longer in his wildest dream than this type of trade. I mean, this DGX, it's a 17 vol stock. It's like blood work. I mean, it's one of these kind of sleepy medical technology companies. You know, the fact that I think, what's the standard deviation from now until April? I think it's like $1. It's so small. So this is a shocking purchase to me. When the volatility is up 4 points from 18 to 22, somebody wants them. That's all I can say. And usually people are right. I think a better trade maybe just would be like the 55-60 call spread, maybe for $1. If there's that much real gas in this thing. But I like always doing the odd block. It's always good for coming up with ideas you probably would not normally have thought of. I just think somebody thinks this thing's going up and it's going to go up in this cycle. So it's a pretty big move.
At least we have to give him some points for at least financing that call buy, so he gets some savvy points there.
So he's like, worst comes to worst, it's obviously he's not bothered with taking the stock, at the 50 level or something. It's a relatively, like I said, low volatility stock. It's got a 10 PE. There's not a lot of risk for the guy. Maybe it's a buyout candidate or some sort of a consolidation. So we'll see. I put it on my screen though, so I want to see if anything else trades in it.
Yes, we will file it in the to be watched category.
I think that's worth one to watch.
To come back to later on and see how these near-term calls play out. Meanwhile, if $55 is too rich for your blood, lest you think we're getting a little high-hat on you, we're going to dive right back now into the type of typical garbage you're used to here on the option block. We're talking Coronado Biosciences Inc., ticker symbol CNDO, trading today a whopping $2.12. If it's the option block, we got to have some cheapo biotech in here. And this is today's candidate. When we saw what looks like, well, we'll start off with the numbers here. About 700 odd contracts a day, seeing 12,000 going up today. Pretty much all of that going up in one size roll, not rolling up and out so much as just out. We saw the May 2 halves going up 6,000 times, and the Nove 2 halves going up 6,000 times as well. So that May Nove 2 half call spread going up for a total of 12,000 contracts. 7,600 contracts open on the May strike, 0 open on that Nove strike. So guess what our friend is up to? Looks like he bought Nove and sold May, correct, Andrew? He's rolling the short call. He's rolling the short call. The opposite. I take that back. He is rolling his overwrite.
So I'm not quite sure what the heck he's doing there. I mean, he's paying. What did he sell the calls for? And he's buying them back for 20 cents. It doesn't make any sense. Actually, it was like, I think it was 30 over 60. I don't even know what he saw. I think that's a love your broker trade. We're going to file that under love your broker trade. Because I just don't see the reason why you would spend, 10% of the value or more of your underlying to buy that option back. So, and to roll it to Nove 2.5. I mean, it's basically saying there's zero is going to happen in this company for 6 months. So now that certainly can be possible, but I don't know if it's the kind of allocation of bucks I would want. So
he woke up this morning, looked at the option chain, and said, wait a minute. Someone's paying 2x more for that same option 6 months out. Why am I not selling that instead? So he had to hit that bid while it was still there.
I mean, I think there's a lot of option trades you could find that could yield a little better than this. I mean, percentage basis, what is that, 15%? Or, if you don't count the gain in stock for it to actually blow through up there. So, I guess if you bought Coronado at $2, you might want to think of it this way, but there's not a whole lot of upside in the thing. I don't know if Alex would approve of this. The viceroy might have to throw his hat down.
Once I said $2 stock, Alex stopped listening.
Exactly. He threw his hat down.
He pulled his hat over his ears. All right. While he's not listening, let's move on to the next name here. A little bit pricier for Alex's sake. This is Spectrum Pharmaceuticals, ticker symbol SPPI, closing today $7.78, so roughly 3x what we were just talking about. And what we saw here was a little bit of flip of the script and not rolling the short call so much as coming into the short put side of the equation with 3,000 of the May 7 puts going up for about, looks like prices around 40 cents for the most part. Looks like these were sales. Of course, there's really no open interest anywhere on these strikes except for that May 7 put strike where there's 3,200 open. So it looks like this is perhaps closing sales, Mr. Andrew, or do you take the contrarian view that this person is adding more?
Again, we'll check tomorrow, but I'm saying I'm taking the contrarian view. The seller is taking, kind of the lower end of the scale for the stock, and whacking these things out because they were trading 40 cents. Now they're off for 35. So clearly there was a window there where these things were a sale. So I'm feeling like it was either a long that they closed, but they couldn't have made a whole lot of money on it. Maybe 10, 15 cents, maybe, or this is somebody that is looking to basically take the underlying at the 7 handle. So it looks more to me like the latter than the former, because I just don't think there was enough money to be made for a long seller getting out. It would feel more like a scratch, and that's possible. But the vol's up for some little reason, and somebody sold into it. So again, it's an odd block one. It's a little bit harder to figure out, but obviously checking the open interest would answer the question tomorrow. But it was definitely a sale. Somebody went out there and hit a standing 40 bid.
That's what we're all about here in the odd block, solving those options puzzles. What fun is it to look after the open interest numbers are out? Anybody can do that. We dive in ahead of time. Consequences be damned, sir. All right, last up here on the old odd block, we have Prologis Inc., ticker symbol PLD, closing $40.11, down about $0.50 on the day today. This is the name that does a whopping 500 contracts a day. doing about 3,000 today. And once again, pretty much all of that coming in one trade. Once again, it is upside calls, but we're not buying this time. We're selling. We're selling some APE 41s, 2,885 times against an open interest of just 69 contracts. These prices, these options, I should say, these calls went up at about, looks like on splits, 32.5 cents. And looks like this was tied to some stock. So you think we got another little overrider here, a buy rider here, Senior Andrew? Looks like nothing's happening between now and APE expiration to the upside.
Yep, just straight overriding, looking for, that kind of a little less than, what is that, 30 cents? A little less than 1% per month for the overwrite. And generating that plus the divvy. I remember trading REITs like this, where that's what a lot of customers did. They just took the small premium and ended up with decent yearly returns on these REITs. So it has overwrite strategy written all over it. Probably not a bad way to trade these REITs for most people, because you get the calls. They don't go up very much. You get a little call premium, plus you get the divvy, and it ends up adding up to some dough.
Yeah, you get the dividend, because most of these are pretty high yield, and you make your own dividend on top of that, a little cherry on top. A nice little package at the end of the day if you're trading some of these REITs. So interesting one here to finish up the old odd block on. Odd in the fact that it's kind of one of the more normal trades we profiled in a while.
it's totally vanilla.
All right, and that is going to do it for the old odd block. And now we're going to keep on rolling right on into the Viceroy segment, a.k.a. the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, listeners, you know what time it is. It is time for the Viceroy to don his fancy cap and take us behind the scenes into the mystical and magical land known as OX by Charles Schwab. Mr. Viceroy, tell us what was going on behind the scenes. I know you alluded to it at the top of the show. A little bit of consternation over our Friday settlement in SPX. So walk us through what the customers were concerned about and what the trade desk was walking them through over there at OX.
So a couple things to remember. The SPX option, the conventional SPX option, stops trading at Thursday at the close, Thursday of expiration week at the close, and settles to the opening print on Friday morning. Now, let's talk a little bit about that opening print, because what's done is the exchange establishes a settlement price. In fact, it is ticker symbol SET. And what SET is a compilation of the first trade, the first tick in those 500 opening issues. And keep in mind, they might not all open at the same time. Friday's settlement was $18.93, which was a price a good distance away from any trading price throughout the day. And the consternation comes from the folks who went home and were short options that were out of the money, come in and see a market that is relatively unchanged and have an opening settlement which moves their options in the money. So, what do we learn from this? We learn from this a couple things. Number one, if you're trading the SPX, be out by Thursday's close, because Friday's opening is simply an event that you can't control. And if it works out well for you, you were lucky. If it doesn't work out well for you, of course, the marketplace did a horrible thing to you. And that's kind of what the desk was dealing with this morning, was the unhappiness of customers who either had spread trades on or some trade where they were short the expiring SPX options. But as a general rule, I don't like to see customers come into the settlement because it's just luck at that point if it goes well for you. The last opportunity to trade out of those is the close of business on Thursday. And if you're trading cash-settled indexes and you don't want to be subject to the wacky stuff that goes on at settlement, trade out of them. Now, I know as soon as I say that, somebody says, yeah, but the options were nickel on Thursday. I didn't want to buy them back for a nickel. There's commissions. There's, it just gets to be expensive. I'd rather see them go off worthless. And then I come in the next morning and they're $3.50. And you say to yourself, well, divide $3.50 by a nickel, and you'll see that wipes out 70 nickels. Don't subject yourself to that kind of risk. Trade out of them at Thursday's close or before.
Well said, sir. Advice we like to extol quite a bit here on the old option block. Doesn't matter who you are, retail, professional, just close that stuff out going into expiration. You don't need it. All right, and now we're going to keep on rolling right on into our next segment, the strategy block.
The strategy block.
All right, everybody, welcome to the strategy block. This is, of course, the portion of the show where Uncle Mike dispenses some options, wit, and wisdom. And let me start off the strategy block with a bit of an apology, actually. If you guys have been writing into us on this show or other shows here using the website feedback form, and you haven't heard back from us, you haven't heard your question answered on the show, let us apologize. We had a little bit of a snafu over pretty much the past year. For some reason, random questions just weren't making it through, and all of a sudden this weekend, we got a massive explosion of pent-up questions coming through. So we fixed that issue. All those questions and comments are now coming through, so I'm going to do my best to surface all of them on this show in the coming weeks. So you guys who've been waiting for a year in some cases to get your questions or comments answered and your stuff aired here on the show, we're going to make sure you get that, because you guys take the time to write in. I want to make sure we take the time to address your comments and questions. So if any of you out there felt slighted, we apologize. It was a technological snafu. We weren't overlooking your question. And speaking of questions, Uncle Mike and I like to joke a lot here about the stupid on this show. And a listener just wrote in using the website saying, calls himself Mr. Don't Want to Be Stupid. Good handle. He writes, I keep hearing about an option strategy described as a stupid, especially in the odd block portion of the show. What is a stupid? Well, Mr. Don't Want to Be Stupid, luckily Uncle Mike Tosaw is here to educate us all on the finer points of the strategy known as the stupid. Uncle Mike, take it away, sir.
All right. Now, with that being said, I want to tell you the traditional stupid is typically not what I do, and the stupid that I'm going to describe to you, I guess it's kind of the modified Tosaw stupid, and I really don't do it that frequently, but nonetheless, I do want to explain to you what it is and why I do it and when I might possibly do it. First off, what is a stupid? Stupid is a trade when, let's say that XYZ stock is trading at $50 a share. And you could buy a $50 call on it. That would just be being long a call. But instead of doing a spread, instead of doing a calendar spread, a covered call, or whatever the case may be, you would also buy a $55 call. So you are technically not in any one spread position. You're in a $50 call and a $55 call, both long calls at the same time. And that is called a stupid. So with that being said, obviously, Mr. Longo really hates that strategy because he says bad things about it all the time and hurts my feelings. And I'm seeking therapy for it, so I'll be sending you some bills for that, Mark. But nonetheless, I want to explain to the audience how I have used the stupid in certain ways and how it can be a useful product, or a useful tool, I should say. Now, let's say that XYZ stock is trading at 50 again. And I am looking at my long portfolio, and I believe that the 55 calls are really dirt cheap right now. I think that I could buy some 55 calls at a really low price, but I'm looking at this and I'm thinking, well, you know what, if this thing doesn't move, I really don't know how I want to do this, but I'm just not quite sure. So this is a strategy that I have used in the past, and I'm going to go into the second level of the strategy shortly. let's say that I can buy the 55 calls for 8 cents. I'm going to buy 100 shares of XYZ stock at 50, and then I'll buy the 55 call for 8 cents. And now, I'm sorry, let me rephrase that. I will buy two 55 calls for 8 cents each. And what happens then is, let's say that XYZ stock goes my way a little bit. XYZ goes my way a little bit. Those out of the money calls, hopefully, double in value, let's say. Woohoo, I made a whopping 8 cents on the deal, or I made a whopping 16 cents on the deal, whatever the case may be. What I want to do is get out of those call options after just the least amount of upside effort or least amount of upside movement, to where now I own that 55 call at 12 cents, let's say, whatever the case may be, at a zero cost basis, because of the fact that I've taken profit on the one and then I'm just going to let the other one ride, so to speak. So now my position is that I am long the stock, and I am also long one 55 call at a theoretically zero cost basis. Now, the reason that I would do this is, let's say that this is a stock that I kind of view as a high flyer, and that once it gets going, I want to take my profits because this thing could be a little bit choppy on me. And at the same time, I believe that volatility is low on those 55 calls, because I think those 55 calls are just dirt cheap compared to how expensive that they should be. So now let's say that stock goes up to $55 the next day, or in 2 days, or just at some point before expiration. Well, at that stage, what I can do is sell the stock. I am out of it. I am done. All of my risk is off the table. But the worst feeling in the world, of course, as a trader, is when you sell a stock and then it continues to go higher. Oh, crap, I got out too soon. With the use of the Tosaw, Texas stupid, that does not happen. Because of the fact that you now own that 55 call, you have unlimited upside and you have zero downside, because of the fact that you bought that call at such a dirt cheap price. You believe that volatility was lower on a stock that you believe moves all over the place. So now you can rest easy knowing that you didn't get out of the stock too early, because of the fact that even if it does continue to go higher, you have that call option working in your favor. Now, let's say the stock then goes to zero and you were right. Well, what the heck? You already you didn't have any risk theoretically on that 55 call option, and the market already went down, and you can maybe buy the stock again and try it again. What the heck? Now, the other way with which I use this is in combination with a 1-by-2 ratio spread. Now, I've talked about the stock repair strategy on the show before, to where, let's say that, or just the most people call it a stock repair strategy. I think it's a strategy you can use initially right off the bat. Let's say that I like XYZ stock and my sentiment is that it's going to go from 50 to 55. I can buy one 50 call at $1, let's say, and then sell two 55 calls at 50 cents each. And then I have free upside theoretically between 50 and 55. Now, where this would come into play is, let's say I did that strategy and then the stock goes down on me. Well, if that's the case, then those 55 calls then become a lot cheaper, maybe in a different month. And that would be the point with which, if I'm still uberly bullish on the stock, we would create a stock option stupid in combination with the 1-by-2 ratio spread. Now, with that being said, I haven't done this strategy, folks, in probably a year or two, just because no premiums have matched up for it, and it's not really a big part of what I do by any means. But with all the crap I get from certain someone whose name is Mark Longo on the stupid, I did want to explain how it's been used, how I use it, and how it's been done. And that, folks, is the Tosaw, Texas stupid.
Yes, the stupid does get an inordinate share of crap here on this show. People probably think you trade it all the time, so I will defend Uncle Mike Tosaw. He doesn't trade stupids as often as I may imply. But let me just clarify my stance on the old stupid. I think straight up stupids are indeed stupid. I think buying the 50-55 call stupid is stupid. I think the way you do it, Tosaw, is interesting because I've said it before. It's kind of more of a rolling stupid. It has momentum behind it. You know, I can understand that. That makes sense. You have the trade going your way a little bit. You're playing a little bit with house money and you want to move on to another strike. That makes a certain amount of sense. Coming in and establishing off the bat, I want the 50 and 55 strike. I see very little clear use cases for that outside of just being indecisive. That said, there is one interesting use case I did encounter just a couple of weeks ago. I was looking at some demo software for some trade recommendation strategies at one of these conferences I was attending, and they had some software that was to recommend trades for very large institutional clients. And they kept putting forth, you type in whatever your criteria may be on X underlying, and they were putting out, let's say you want to get long, a lot of these guys want to get long, these typical underlyings. They were putting out recommendations with tons of stupids, 3, 4, 5 legs, buying every strike in existence. So I said to these guys, I said, what's going on with all the stupids? Why are you telling me to buy 10 different strikes instead of one? The way they justified it is that their algorithm showed how much was displayed on the bid and offer. And so if you're doing a large institutional size and you don't want to move the market too much against you and cause a lot of damage to yourself in terms of slippage, then you could try to hit multiple strikes at once and get those deltas and those Greeks off simultaneously there. That was their rationale for it. I don't know how I feel about that either being that effective in the marketplace. Market makers aren't idiots. Once they get hit on one strike, they adjust. But if you can do it all simultaneously and get all of your positions on with a minimal amount of market impact, I suppose the stupid has some value there. So there you go, listeners. 2 use cases of the stupids that I may somewhat approve of. And there you go. That's my tacit approval of the stupid. Well done, Uncle Mike. And now we shall keep on rolling right on into our final segment, Around the Block.
Around the Block.
All right, welcome to Around the Block. This is, of course, the portion of the program where we break down what we're watching, what we're keeping an eye on for the rest of this week. Of course, there's still the global macro stuff that's kind of weighing on everything. Everyone's watching and waiting to see what comes out of the Ukraine-Crimea situation, so that, of course, is on everyone's radar. What else are you watching? Starting off with you, Uncle Mike Tosaw, that is keeping that BBI high, keeping you up at night.
There you go. We're going to have a parade of Fed people coming out over the course of this week, most likely just giving interviews and saying, well, what we really meant by that was this, that, or the other. I think we're going to have an interesting week this week just from seeing what some of these regional people have to say. And just curious to see how that plays a factor into market movement.
And Senior Giovinazzi, the Rock Lobster, what are you watching for the rest of this week, sir?
My little nose is looking at the Treasury vol. It's super cheap. It feels like, I almost feel like there's some kind of short squeeze going on here because of the way the vol's so big. There's some upside curve. It's almost like everybody, that this QE thing and this bonds going down is such a slam dunk. So I don't know. I'm still not quite sure. Like, if we're at this level, whether, again, like you said, there's the global geopolitical junk, or just I think there's a few too many people short treasuries, and if we can get a good old squeezy up on it. So the vols, at the money vols, relatively cheap in there. Skew a little bit more expensive. So that's really, I'd like, if I could see the treasury sort of melt a little bit, I'd feel a little bit better about, actually going and maybe selling a little more juice in the index, like in the SPX type index. So that's really what I'm watching. Skew came in a little bit today, market down, vol barely budged, even on a day when we should have seen a weekend markup. So, net, I think vol actually reads lower, even though there was fractional upticks in them. So that's what I'm watching and waiting for.
And Mr. Viceroy, what are you watching for the rest of this week, sir?
As Andrew pointed out, our 10 has had the volatility drain out of it relative to what's still going on in the Bund of the Gilt. And so still huge volatility in the German and the UK market. And I think that's all the geopolitical events. We got a few earnings starting this week. BlackBerry, Alcatel, Walgreens. But I think the geopolitical events are going to overshadow earnings, at least at this point, until we get into the meat of the earnings season.
BlackBerry, nice strong name to kick off. We'll be paying attention to all of it, but unfortunately that is all the time we have for this episode of the Option Block. And before we go, let me check in really quickly with all of my cohorts, my partners in crime here on the old ASP to see what they have cooking in their necks of the woods until the next time we gather here together on the old All-Star panel. Starting off with you, Uncle Mike, what is cooking on the old RCM webinar train?
Well, we got a full slate of webinars coming up in the month of April. I will have full details next week. We're taking this week off.
All right. And Mr. Andrew, what is cooking in the land of the pit?
We launch our new gold class tomorrow, which means people can learn about options on their iPhone, right? So all our content, we created all the educational content is streaming right off the website. So people that have devices can, look at it and learn in little tiny snippets. And then, of course, there's still the intraday live part of the course that we record and post, obviously. But for people that want to catch it live, it is available as well. So that we're going to be launching soon. That's what a lot of people have been asking for, so they can, when they're commuting, obviously not driving, but on a train or subway or something like that, they can download the course and sort of learn at their convenience. So that our gold course, the new gold course, launches tomorrow, essentially.
I don't know. I think Behind the Wheel is the best place for options education. Draw some graphs on your own while you're driving. I think it's good stuff. All right. And speaking of education, Mr. Alex, what's cooking in the land of OX by Charles Schwab education?
2 live events. March 29th, the crew will be in Baton Rouge, Louisiana for that 3/4 of a day event. Then April 26th in Schaumburg, and I may join Jimmy Rouzan for that one, talk a little Idea Hub and Walk Limit. Live events are all simulcast on the site. Just come to optionexpress.com. 3 podcasts I'll talk about. Wednesday, March 26th, Nina will be doing the platform, new features of the site tour. Thursday, March 27th, she's going to be talking about covered calls and IRA accounts. And also on Thursday, the 27th, Russell Rhodes from the SIBO is going to join us and talk about the 4 major VIX benchmarks and how to trade them. The short-term VIX, the VIXIN, and the Russell VIX. All the events are free. Just come to the site and register.
All right, and that is going to do it for this episode of The Option Block. And on behalf of Alex and Andrew and Uncle Mike, and of course myself, I want to thank all of you out there in the listening audience for writing in with such great questions. Again, I apologize for all of you who got lost in that strange website comment question snafu, but don't worry, all your stuff's getting through to us now, so we'll get a chance to surface all of you, or as many as we possibly can, in the coming weeks. And we'll see you next time right here on The Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.